Hello and welcome to the 6th of our lecture recaps for ACCA P7 Advanced Audit and Assurance. This lecture was on liabilities. So the liability of the auditor. Remember that the duties of the auditor are to report that the financial statements are free from misstatement, that they're properly prepared, and that the director's report is consistent with the financial statements. So that's what we're reporting on. Where would our liability come from? Well, first of all, you may have a criminal or civil liability under legislation, or under common law through negligence. Firstly, looking at civil liability. Well, if a third party suffers a loss due to a negligent audit report, this will lead to a civil liability. For example, in an insolvency, if the creditors have made losses because the auditor has issued a negligent audit report, they will have a liability to those creditors. Under tax legislation, if the auditor is aware of a tax fraud, then they will have a liability there as well. Under financial services legislation, there will be liabilities, and under stock exchange rules. The penalty for civil liability is damages. On to criminal liabilities then, remember that the penalty under criminal law is fines or indeed prison. And such things that may lead to criminal liability are accepting an appointment when you're ineligible to do so. Also, any fraud, insider dealing or false statements. All of these things will give you a criminal liability. So let's look in more detail at the liability to clients and to third parties. First of all, to the client. Well, your liability to the client is under contract. Remember, you have a contract with the client and will have liabilities under this. The instances in which you will have a liability, well, maybe you breach the contract, you fail to deliver the audit report, or you deliver a negligent report. Both of these will be a breach of contract and will lead to a liability. Or if you don't perform the audit with due care and skill, again, that will lead to a liability. However, if you have complied with all the ICEs, there will be no liability, because you have complied with all of the international standards. On then to third parties. When do you have a liability to third parties? Well, your liability will be in the tort of negligence, and to prove negligence you have to prove three things. Number one, that the auditor owed a duty of care to the third party. Number two, that there's been a breach of that duty of care. And number three, that the loss has been suffered directly due to that breach. So you have to prove all three of those things. A couple of cases which set this out. Well, Kingston Cotton Mill set out that the auditor should be a watchdog, not a bloodhound. The Lord Clayham case. In this, the auditors had a successful defence because they followed the standards and had good working papers. The plaintiff had bought a business, but it was held that the plaintiff didn't make enough reasonable inquiries and had too much reliance on the auditor's opinion. So let's look in a bit more detail at negligence. We need to ask ourselves some questions. First of all, when do we owe a duty of care? Well, we owe a duty of care when the auditor knew or should have known that the injured party was likely to rely on the audited financial statements. This comes out of a case called ADT versus BDO. In this case, ADT was buying a business, BDO were the auditors, and the head of ADT went to speak to the BDO partner, who said that the accounts were absolutely fine and that he stood over them. Of course, there was a subsequent black hole in the accounts. The business wasn't worth anything like what ADT had paid for it, and they wanted to recover the difference from BDO. In this case, it was held that the auditor did owe a duty of care. Okay, so they were responsible for paying the difference that the black hole created. So that's the question of when a duty of care arises. How do we know then if the auditor has exercised due care? Well, you'll have exercised due care if you applied the up-to-date standards, adhered to the ethical principles, and applied and are aware of the terms and conditions under law and under the engagement letter that you have signed with the client. that will be due care. Lastly then, has the injured party suffered loss? Several cases on this, the first of which was the Headley Byrne case. In this case the bank provided a reference, and of course the business then failed. Did the bank then owe a duty of care? Well, it was held that yes, because they had provided this reference, they did owe a duty of care. However, they had disclaimed their reference at the bottom with a disclaimer, and that meant that they didn't have to pay any damages. They did owe a duty of care, but because they disclaimed, they were fine, didn't have to pay the damages. The test set out in this case was that, was the loss suffered? Was negligence proved? Was the loss as a direct result? And was the expert aware of reliance on their opinion? If these were all answered yes, well then there was a duty of care. On then to the Caparo case. This was a takeover in which they relied on the audited accounts. It was held in this case that the auditor has no duty of care to assist individuals who are speculating for profit. Okay, so they were undertaking a takeover, they were speculating for profit, and the auditor had no duty of care. What they do have a purpose of doing as an auditor is assisting the shareholders in exercising their proprietary rights. In this case it was held that a duty of care will exist if it is reasonably foreseeable that the plaintiff will rely on the report, if there was a relevant degree of proximity, i.e. that the plaintiff was close enough to have a degree of proximity, and if it was just and reasonable to do so. Okay, that was Caparo. Then on to Bannerman. In Bannerman, RBS provided an overdraft to business. They relied on the audited accounts to provide that overdraft, and of course the business went under. Did Bannerman owe a duty of care to RBS? Well, it was held that yes, they were liable. They hadn't disclaimed their liability, and they knew that RBS were relying on their work, because when they did the audit they would have seen the overdraft and done audit work on it and knew that they were relying on the audited accounts. So they were liable and had no disclaimer. So how do we restrict our liability then? Well, methods of doing this include screening potential clients, having a proper letter of engagement under ACCA 210, having high quality work, using disclaimer clauses, having professional indemnity insurance, restricting the use of documents to their intended purpose, i.e. stating in them that these are not for the use of third parties, and by gaining specialist advice. Some other possibilities are that perhaps regulations could be set up to put a financial cap on the auditor's liability. They could set up a limited liability partnership. They could permit an agreed limit with clients, or they could modify the joint and several liability with directors. The joint and several liability is where the auditors hold joint and several liability with the directors, so if anything happens the auditors are liable as well, and that could maybe be modified a bit more in favour of the auditors. So that was our lecture on liabilities.